Good morning to everyone. I'm hoping you're all fine on one fine Saturday morning and ready to take a course of today. I welcome you all to yet another session of SBR. And today we are formally going to take a start of a course. We all have met the last week to introduce the course. There are a lot of things I had to share, I had to inform, which I did. And now, after a gap of a week, here we are starting a course. You know the whole plan. We have decided to start the course with consolidation, and within the consolidation, the basic aspects of it, and all of that importance that why do we have to take a start by covering the basics. Everything was nicely been talked about. I guess without waiting for any further or wasting any time on talking about this and that, we can just jump into the start of the course. Chapter 1 on basics, within which all of the basic content has been written, but we're not going to do a book reading. It is there for you to read, which is preferable at this level to develop the habit of reading the text. But especially to cover those basic aspects, I have prepared this one PDF. And this PDF has got a lot of questions. And by practicing those questions, you will be able to refresh yourself with the basic aspects of consolidation, as you can see, flashback. In total, it has 4 pages and 5 pages, I guess 4 or 5, 1, 2, 3, 4, 5. And the questions, those are shared within the basic ones. But like I said, while I will go to work on top of just producing the solution, I will be explaining the amount of explanation that is required at this level and the pace. I told you the last week, I will have to keep it a bit quick since we, on the one side, when making sure that we have the basics with us, but on the other side, we should not be consuming a lot of our time. This was the whole talk of the last week. The past week, we started the whole introduction of SBR by taking this exam pattern. We'll take the next question, second one. First one we can discard, because I feel the second question, when I'm going to work, this will automatically cover that in. As both the questions, they require us to prepare the statement of financial position. But this question does not involve non-controlling interest, as the holding is 100%. While this involves also NCI, non-controlling interest. So this question will cover everything what the question 1 has, and also will take NCI. So better we should take that one question that can cover plenty of things into it and can save a time. You may not even need to attempt this one at your side, not a need for it. So Poodle bought 75% of the shares in Springer That is a date of acquisition, and that is a cost of acquisition. This is an acquisition date. And this is called as cost of acquisition or cost of investment or fair value of the consideration paid. Singer had this much of retained earnings. Singer or Springer? We can change the name either on the two of the sides. Let's change that name to Singer. No, we have Springer over here. So this needs to be changed to Springer. The statement of financial vision of two companies at 31st of December 8 were as follows. There are two sets of financial statements provided. One for the parent, the other for subsidiary. I'm going a lot slowly on the first one especially, but by the time I will finish the next question we will take, I will go a little fast on. Even within the revision of this basic, this is the first one, so this will require to have a bit more time. Non-current assets, investments, current assets, that's the first half of the statement. Capital, retained earnings, liabilities. The requirement is to prepare the statement of financial position of the group for the year ending December 8, assuming the non-controlling interest is measured by using proportion of net asset method. So I will talk about this NCI. The definition of it, the number of methods it can be worked by, and the one that they've exactly asked how to work. So before I get into the solution, let's just go to make a list of steps involved quickly. For the statement of financial position, group statement of financial position, if I'm starting off with, because we will take statement of profit and loss after. See, first, all of those questions are on statement of financial position. You may have noticed. And then there we have statement of profit and loss. So the first will be the statement of financial position. So if I go and make the list of the steps involved that we can apply to it. The very first step, just need to do this. The assets of the parent will be aggregated. The assets of subsidiary, which will be the same in the next step, but then that will be for liabilities. But consolidation is not just about aggregating. If that was too simple, yeah, basic is to aggregate. Consolidate means combine, aggregating, summing up. Consolidate, combined results. But you know that consolidation is not just about aggregating the asset and liabilities. It's a whole world of accounting. So yeah, it starts from aggregating the two of the sides, which you cannot bypass. That definitely comes to our way, aggregating the assets and the liabilities of subsidiary into parent. The parent has a control over to a subsidiary, and the reason why they are consolidated, they are aggregated. Since P has a control over to a subsidiary by being a major shareholder, more than 50% interest. Step 3. The share capital, or may have been the share premium of the parent only On the group financial statements, the capital and the premium of the parent will fit in only. A little I can comment, because we are preparing the financial statements of the group owners. So who is the group owner? The parent. So let the capital and the premium of the owner has to come in. In that you will not consolidate P plus S. It's just the capital and the parent of premium of the parent will fit in. In the step 4, now these things are talked a lot about at level 2. But at this level, the need is not there. For many reasons, because these steps, you will not be asked to really perform at this level. Being a part of consolidation process, at least once or twice, we will have a look at it. But later, you will not see these steps will ever be tested in SBR. And second reason, that you already have got the whole idea about it. You're not fresh to this topic. In the 4th step, remove the P's investment in S. So the investment the P has made in S, that needs to be removed. Whatever the value the question provides to all of us, will not come and remove. In the step number 5, a working of group reserves. And the reserves then can be of this type, retained earnings, or can be the revaluation reserve. In step number 6, is going to be a calculation of non-controlling interest. And then in the last step, the goodwill. 7 steps. Once I have been able to make a list of it, and we'll keep on using for the whole course of today, even with all those sessions to come. These first 4 steps, they have of a little importance in SBR, but these 3 testable. As these 3 steps, they require you to prepare a pro forma of computation, and that pro forma will definitely be asked. The computation of group retained earnings, the non-controlling interest, the goodwill, these are the pro forma of computations. A lot of steps involved in working this one figure, so that you will be definitely asked in SBR. But these 4 steps, they are performed on the face of the statement itself. They do not require to have as such any working load. So they are rare to be tested in SBR, since you're not asked to draft a financial statement so that you have to work these 4. These are the working notes which will definitely be asked. Let's come to apply these to the question we have just read. For that, we need to at least in the start make a blank pro forma. A pro forma of the statement needs to be drafted. Group statement of financial position for the year ending on December 8. Whatever is there just needs to copy. On the side of the non-current asset, the first thing I see is the balance of non-current assets. Within the banner of it, there's going to be a property, plant, and equipment, and the investments. And we have current assets very next to So that is the first half of the statement. In comes the second half, we have share capital, beaten earnings, the capital side. And then comes the balance of liabilities. Yeah. A blank pro forma. As you all can see, it's blank. Just the titles of those components, asset liabilities, have been written next to that, and no figures. Now we can nicely apply those 4 steps over to it. So next to that, just need to add up the assets of one side into the next 342,900. I also can try and keep that pro forma as a draft so that later, if the need will be there, we will save time on rewriting. $342,900 and then 201,4100. The figure of investment is found only in the first column, 150,000. While current assets 75600 and 41600. And that's what the first step is about, adding the assets of parent into S. Liabilities to next, 69 and 28. So to once or twice to understand the process of consolidation, it's good that you don't bypass those 4 steps. Just try to perform them off once or twice, so that as a accounting student, professional student, you know that, okay, the consolidation starts off by this first, second, third, fourth step. Although I may not be examined on these 4 steps, but yes, I must be informed of. I must have an idea of it if I cannot recall it. So for that reason, once or twice in this question, and there's going to be another one, we will apply that full process of. Third step was to record the capital in the premium of just the parents. So that needs to, this amount needs to be focused. That's the capital of the parent. So the moment it's been focused, I will just come to fit in next to it. That's the third step. The investment the parent has made into S, it's written on 2 spots. First, in the introductory paragraph. And secondly, for surely in the financial statements of parent. Definitely, if the introductory paragraph does not state that, this definitely will state. P invest in S, so that definitely will be found up there. And that needs to be removed. So let's come to remove it. This is the 4th step. See, 4 steps. On the face of the financial statement, I have been able to prepare. No working note as such was required. And that's the reason why these 4 steps are not going to be examined, because they require you to prepare a whole statement, which in SBR, you will never be asked to prepare the whole statement. The other day, I was telling you that now from September 2003 onwards, your spreadsheet will be pre-populated, pre-filled. In simple words, the draft group financial statements are already there and it's locked. You rather will be asked to pass the adjustments in, which are the corrections. So corrections can even be within those steps also now. Can be possibility. Where these 3 working notes will definitely be examined and you will be asked to perform some further computations in adjustments into corrections into can be a case. Now, these first 4 steps have become important because previously, like I said, you never had been asked to prepare a statement. So these 4 steps you will perform. No, you will not. You have not been. But because the exam testing for the question 1 has changed, so you never know these 4 steps, which now I'm providing you with the knowledge of, can become the part of that correction or may not. You need to at least have the knowledge of it, which is what you are right now gaining it, being the part of this revision. And basic these are, and will remain basic. No matter how tough the scenario will become, these 4 steps will be like these basic. Nothing more needs to be done except combine it. Write the capital of the parent. If we have premium, then also for capital. Remove the investment of P into this. That's it. Whereas this is going to be a working. And how the way the working note of this needs to be organized. Now, the question involves another thing. I'm not taking you towards. In the end, I will unfold NCI. Let's not look into it. Now, this is group retained earnings or consolidated retained earnings. For surely, we'll also be taking the same theme of combining the profits reserves of subsidiary into the profit reserves of parent. My own profits plus my share of subsidiaries profit. That should be the basic theme of this pro forma, because the idea is to consolidate. So that's what we are doing. My own profits, adding it up by my share of subsidiaries profit. My share can be 80, 90, 70, 75, which in this case is 75, I guess. Yeah, 75. Can't take the whole profits of subsidiary, only my share out of it, 75, 70, let's say. So basic theme is consolidate. So that's my profit plus that's my subsidiaries profit. That will be a consolidated balance of reserve. So you combine it this way or this way. Theme is same, that we need to consolidate. We need to combine it. So how will this will filled? I will take the balance of my own profit because what's in my pocket, that's obviously for me. So this will come as it is 379500. Because debate is not on what I have itself in my pocket. The debate is what I can claim out of my investment. My investment is into subsidiary. So what is at my side, that's definitely will be copied into it. What I can possibly claim from subsidiary is really a debate right now. So firstly, the group share needs to be known to you, 75% right now. And the amount of profit the subsidiary has made. For that reason, I will have to look into the profit subsidiary, that's 145,000. But this requires to have a bit of a patience and be thoughtful about that. Okay, 145, should I take a 75% of it? No. This 145,000 is a cumulated profit, retained earnings. It's profit the subsidiary has made to date. And the parent cannot take the 75% of this whole figure because parent may have not owned this company since the day it was incorporated. The subsidiary may have been incorporated 20 years ago. But we as a parent might have acquired this company 3 years ago. So we only can take our share from the profit this subsidiary has made in the last 3 years, not all the profit that the subsidiary has made since it's incorporated back in 20 years. And this at this level to understand is a very easy thing. to digest. I guess no more talk is required. This is the profit the subsidiary had it with them the day I have stepped in. Means this is the profit, they already had it with them. I have no control over to those. This is the day I have become an owner. And since that, the profits have gone up to this level. It means after I have stepped in, this much of profit the subsidiary has made since then, and I then will have a control over to those 15,000. And that is what we call it as post-acquisition. After acquisition, what is the amount of profit subsidiary has made after we have acquired is 15,000. So that just requires to analyze it this. And that is called as post-acquisition amount of profit. This is the basic theme, and you can immediately associate yourself to it because you definitely have done this in the life in the past, and you can immediately say that, oh yeah, I remember this discussion post pre-acquisition profit. So 145,000 is a pool of profit. And that pool is 20 years old pool. I have rather stepped into 3 years ago. So I only can take a part of a profit and take my share from, and that you simply can work that out by analyzing the profit they had it the time I have stepped in, the profit that today has become. So what they have made since then is 15,000, that's post-acquisition. And this how the way this working will come to an end. 75% of this figure has to be 11250. 11250 plus 390750. So my profits plus the group share of my subsidiaries profit. That's how the way this working will be done. Now a reserve can be of any type. It will be same. May have been a revaluation reserve or retained earnings. It will be the same for both. After working that all, now we can take our focus towards non-controlling interest. What is it? How to find? Where to present? In the same question, we do have NCI. So what is it? Non-controlling interest. See, if parent has acquired the subsidiary, like in this question, by 75%, they definitely has a control over to it at it's more than 50%. But they are still not the sole owner. There are others also. Since if P buys 75% of the shares of the S, someone must have been holding the other 25%. That someone's interest is called as NCI. Stands for non-controlling interest. Let's go a little slow. Non-controlling interest. They do not have a controlling interest. They are the minority owners. They are in minority, less than 50%. But they're still the owners, that they have an interest in a company, but that interest does not give them the control over to. They're called as NCI owners, non-controlling interest owners. That's the definition of that. No need to cram the bookish definition of NCI. If you know it, what is it? Enough at this level. And there are two methods to work NCI. The one is the one that they have tested, which is called as proportion of net asset method. And the second one is called as fair value method. Both of them are testable. Both of them are applicable. More common nowadays is this one. But both are testable, both are applicable. Need to be aware of how the first one will go. Like it takes, as a name suggests, proportion of net asset method. So we take net assets and multiply it with the NCI proportion. So the title of the method has itself the whole formula in proportion of net assets. So we are taking a proportion of net asset of subsidiary. Whereas the other one goes like this, it takes the number of shares multiplied by the price of each share and multiplied by the NCI's percentage. Both are testable, both in a very quick manner. On this page, I have been able to explain. Let's go to apply in the question that we are attempting. And where are we going to present it, by the way? The NCI will be taken which spot within that same pro forma. Let's not forget they are the owners. So they will fall under the banner of owner's equity, as they have been holding this much of equity, 25%. So make those relations, and so that you never forget, just don't try to see it, okay, once the lecturer has written, so fine, I'll have to follow. Think of that, okay, what is NCI and where am I supposed to fit that in? They are the owners. So they should come under the banner of owner's equity, capital side. So just next to the normal capital side and before writing the liabilities, the NCA has to take a spot right in between here. Let's go to complete the working note of it, non-controlling interest. Now, these are all of these things you may have realized it the past 30 minutes or so since the time we are into that you have been missing it out from your life. And this revision will prove out to be so important for the whole advanced lectures to come on it. Then you will thank me later. So which method they need to adopt, they want us to adopt is proportion of net asset method. So proportion, we know it's 25%, but what has been the balance of net asset? Let's go to look at it. For that reason, I will have to go and work one more thing. Which is called as net asset working note. Net assets of subsidiary. Now it will comprise of having two columns. The first one will be for the day of acquisition. Second one for the day of reporting. Here we have share capital. And here we have retained earnings. Means all of the capital side that the question has it presently, we will take. If I have premium, I would take it. If I have revaluations, I will take it. I do have only two things. So these are the two things can fit in because net asset equals to capital. So capital side has to fit in. And we have two things to fit in at the moment. This has been the balance of capital of subsidiary. So let's go to fix it in. And the balance of capital does not change. It was seen to be as 70,000 and will remain to be 70. Since no new shares the subsidiary has issued on the way, because capital balance only gets affected by the reason of issuance of shares, right issue, bonus issue, normal price issue. Otherwise, the share capital is the balance that does not take any effect except the issuance of shares. So what was seen still be seen today. It's as if the opening balance of the T account is 70, the closing will become the same if there are no further movements, debits, credits. But that should not be the case with profit, because profit keeps on pooling, keeps on accumulating. So the profit that was seen the time that company was acquired has gone up to this mark. And that's how the way this working note. And see, we've got the same thing out of it, that earlier on, we were trying to figure that out informally. See, that 15,000 that I was trying to figure it out informally has its way of working. That way is this 15,000. And this also has enabled us to get the balances of net assets, both on the date of acquisition and on the date of reporting. So this is one vital working note, which will facilitate many of those things later to be used in the question. So we have got the balance of net asset, and I will use this to work the proportion of net asset with this 200,000 multiplied by that 25%. So the proportion value of net asset will be 50,000. But that is not it. That's proportion of net asset value. Just the way the subsidiary has taken a 75% of that share of profit, the NCI will take the remaining one. We'll have to write it as NCI share instead of group share. And we'll change that to 25% instead of 75%. So systematically, like partnership sharing out of profit, I take 75 of that figure, the NCI take the 25% of this, and that figure remains to be the same. And we are just done with this. Just need to formally find the totals of it. I guess the battery of this calculator is not supporting me. I usually do not have a tendency to use the calculator on cell phone, so I use it the same old traditional way of working the answer. But students nowadays, they always have the cell phones and they keep on using it while they even have to use the calculator. But develop the habit of using the calculator instead of the one that you have it on cell phone. 53750. Once the figure is being punched, let's try to close all of those brackets to try and conclude our first most question to see if it is okay. 342900 plus 201400 gives us the total of 544,300. On the side of the current asset, 75600 plus 41600, 117200. Should be the same down below. Let's check. 69,000 plus 28,000, it's about 97,000. So 120,000 plus 3970, 510750. See, we've got the same. A basic of the basic question we have taken, but this has made us all see the whole process. 5 steps of consolidation, or 6 steps. In fact, the goodwill was not a part of it. We will gradually include it, but these 6 steps all nicely revised. So this first question has enabled you to get back to the same level that you have gained it in previous courses, which while coming into SBR course, we really as a student don't take a care of it. We don't feel responsible to have that knowledge with us. We just step into course. We've talked about this a lot the last week. The fault is not yours, it's natural. And then we've started off this revision phase. Any issue with that? Okay, if in the same question they had asked us to apply the fair value method, how the way things would have differed. Instead of this figure, I will have to replace it with fair value. Only that change would come in. Because that's proportion of net asset method. That just will be replaced with fair value of NCR. Nothing will change. This will still be the same as no matter the fair value method has been adopted or proportion. This step is applicable to both. That's like sharing of profit to two of those owners, 75%. I take it, the 25% they take it. That definitely will have to come in, regardless of the fact you have a proportion method or fair method for NCI. Just the fair value will be replaced. Either the fair value will be given, just will be copied, or if they require us to calculate the fair value, the way will be this. And fair value will only be applied when the question will provide us with the related facts, like the share price should have to be there to find the fair value. This question does not provide it anywhere else, share price. Yeah, we do have number of shares with us. Assuming the capital usually is a $1 share. So the quantity of the shares will be the same as the monetary value. The percentage of NCI, we have it with us. The only thing that's not been there is the price of the share. But proportion method can be applied in any given situation. Okay. Let's take ourselves down to goodwill to try and include the seventh step. A little bit I can brief you on what is goodwill and how will it be worked. What types of goodwill do we have? Where to present? All coming to your way. There are two types of goodwill. The goodwill that we're talking about is the purchased one, not internally generated, because internally generated goodwill cannot be capitalized, a reputation. Purchased goodwill is when one of the company acquires another, and as a result of that acquisition, the goodwill that arises is called as purchased goodwill. The one that we are going to talk about, as parent has acquired the subsidiary. So as a result of this acquisition, the goodwill that will arise will be called as purchased goodwill. Purchased goodwill can either be a positive one or can be a negative one. Positive one or can be a negative one. Purchase positive goodwill is capitalized, and after capitalizing, reviewed for impairment. Annually, to add the word annually, because impairment thing is not annual activity. Exceptionally to the goodwill, it's annually to be tested. Impairment review is a task that is performed on need basis, when and only when the circumstances will give us the push. There are some internal factors, external factors. Otherwise, it's not like depreciation or evaluation which will be done at each year end. There is no regular pattern of, but goodwill is reviewed for impairment on annual grounds, regardless of the fact there are some factors there, not there, situation is there, situation is not, still the goodwill will be tested for impairment on annual grounds. While negative goodwill is credited to profit and loss. Credits to profit and loss. Like a discount, it's also called as bargain purchase. And I can brief you on why is it. What is a basic way of computing the goodwill? It takes on the fair value of the consideration transferred, consideration paid, less the fair value of the net assets acquired So the first thing is the payment. The second thing is what we have claimed in return. So it's going to offset the two of those values to find the net answer, which in fact is going to be a figure of goodwill. The goodwill is always going to be a balancing figure. The payment of consideration is usually a cash payment, but there are plenty of other ways the consideration is settled by share exchange transaction, loan exchange, note exchange transaction, sometime assets exchange, land building, plant exchanged. Sometime the consideration is although in cash, but it's delayed payment, which is also called as deferred consideration. Sometimes it's contingent consideration. So there are a lot of types of consideration we will also come across. But majorly it's cash consideration. Whose net assets are we acquiring? Subsidiaries' net assets. So the net assets are the net assets of subsidiary. Positive or negative it can be. So I can make one case on the positive goodwill, the other one on a negative one, just to see both the sides of the topic. Copy and paste that pro forma and then can fix in the figures. So in my first, let's suppose the consideration that was paid was $2,000. And the value of the net assets we've acquired worth of 1,700. So the positive figure that we have got is 300. So after working this, what actually has happened? This is the price that they have paid. And in return, this is what they have got. And this is the amount that they have paid extra. Because that has been the value of the business. See, the value of net asset is in fact the value of the business. In order to find the value of the company, what do? You try and find the value of net assets. So fair value of net asset is in fact the fair value of the subsidiary that they have acquired, which is this. And they have paid this 300 more than what they should have. So why have they paid 300 extra? What was the whole reason behind? Because this company was highly reputed, and whoever who wants to buy a company of this kind has to pay a premium, because everyone will be wanting to buy a high quality. Even in normal day life, that applies to you also. When you go to buy an item from market which you know is a good quality, branded, more life, durable, so you don't mind paying extra price over to it because they charge you for that. You pay a premium, you don't mind paying it because you know what you're getting in return. So that's been the case. This company was highly reputed for many odd reasons. The company has got a lot of sales, good cash position, quality products, long-standing history, refund and exchange policies are so good, customer scarce. So because of a lot of quality attributes being attached, this company, everyone in the market values this company to be a good one. So whoever has bought has to pay a premium. So that extra payment is because of the reason of that reputation, and that is goodwill. premium. And if I also have to write it in the way of passing the double entry, what will be debited, what will be credited? So definitely, because there has been a payment, so I'll have to credit the bank by the amount of 2,000. On the other side, this has been the balance of net assets that they have ended up acquiring, worth of 1,700. See, the balancing figure naturally falls onto a debit side, which will in fact be the figure of goodwill capitalized. See, that's what they have paid, that's what they have acquired. 300, the balancing figure naturally falls onto a debit side, which will be the figure of the goodwill capitalized. The capitalization of the goodwill can only be done in group financial statements. In individual financial statements of parent, it cannot be capitalized. So goodwill is a component of group financial statements. So it will be capitalized in group financial statements, not in the individual financial statements of parent. Goodwill cannot be capitalized in individual accounts. It's a consolidation component. It's the group financial statement component only will fit in, not in individual financial statement, because in the financial statements, it cannot be capitalized. Let's make another case, this time for the negative goodwill. And then we will be back to our questions to apply it in a more of consolidation manner. So this is case 2. Randomly, let me fix the figures in. The payment of consideration is 5,000, but what they have got in return is 5,500. So the negative goodwill that I have found is 500. Once again, this has been the value of the company that they have acquired, but they have paid 5,000, which means 500 less payment. What has been the possible cause, reason of this less payment? Like a discount. They have ended up getting this company at a bargain price, reduced price, discounted price. And why for? Because this company, opposite to that, is not a good reputed company or carries a bad reputation. Company has got lots of operational issues going on. Many of those employees, they have left. Loss-making company, liquidity situation is not as good. So everyone in the market is being aware of the problems that this company has. It already has developed that bad reputation, a company that no one would be wishing to even acquire. So the one who has been able to acquire it cheaply. And that happens to you also when you go to acquire an item which is usually at promo, is an item which is close to expiry, that not many users would be willing to buy that item as it's close to expiry, or because of many other reasons, it's no longer in demand, so that not many of those users that they will be willing to, as many of those users they already have. So there's no demand for that. So you normally find those items being on promo to attract the customer to come and buy at cheap price. That has been the case with this company also. And that's the reason why it's called as negative goodwill, negative reputation or bad reputation. So what needs to be done with that? According to my explanation, up credited to profit and loss. So let's go to prove it out by passing a double entry. That how will it be credited? The double entry will prove it. So I will still have to credit the bank with the payment of 5,000. Was it? Yeah. Well, the balance of net assets will be 5,500. It means that the balancing figure naturally will fall onto side of the credit, which is the one that I was talking about, will go into profit and loss. See, it's proved out. But the credit will be into profit and loss. It's like a discount, other income, miscellaneous income, sundry income. The profit and loss will take it like a credit balance. So that's the basic talk of what is goodwill, how to basically compute. Two steps involved, can be positive, can be negative. The one that we will capitalize is going to be the positive one. Negative goodwill is not also capitalized. After completing this talk, now we can take this third application to work the goodwill, but this time even by incorporating the non-controlling interest in, because these two examples I have put forward where the assumption was 100% acquired. But if parent has acquired 60% of the subsidiary, then what we are supposed to write that being the part of consideration payment. So this question will cover it up. So what goodwill arises? Assuming the non-controlling interest is measured by using either of the two methods. So I will work the answer by using the both, and you'll be able to see the difference of both in comparison. So Piano bought 60% of the shares in S on 1st of August 8 for 170,000. But this is all that technical knowledge. Regardless of the fact, later exam style questions will be of what kind, we are beyond to that mark. The course has just started today. I mean, we are at nowhere to even say that. No matter how tough the things would be, testable and all. This technical knowledge to gain is always comes first, and you cannot bypass it. And on the basis of this basic knowledge, the whole of that complex knowledge has to stand on. Remember the example of foundation and the whole 10-story building up there. The 10-story building up there stands tall if the foundation is strong. And this is foundation that you cannot be taking it lightly, compromise it, or you just can bypass it. So right now, your focus is just to come into the course and see what's happening and try to digest all of that knowledge that's thrown at you. How the exam questions would be like to apply, when to practice and all. These things are beyond your understanding. Too long the time, we will have to go and look into it in a very nice manner, but just keep on appreciating the knowledge that's been thrown at you, revise it, try to revise it at your side also, so that I just don't complete my revision. You should also get the benefit out of revising it. This is for you. So if at the end of the day, I'm revising it, and then after 2 weeks, you're still at the same level that you were on 2 weeks before, then that's the whole waste of a time. The fair value of the net assets is provided. The fair value of DNCI is also provided. That's how the way some questions will provide you with a fair value. So let's go to work that pro forma. We've been asked to work the goodwill. So the goodwill will take the same 3 steps. I can call it as cost of investment. Fair value of the consideration paid can even be called as cost of investment. Topping this up with the fair value of net assets acquired. That's a pro forma you people have seen, haven't you? I just have changed this to cost of investment, can even be called as cost of acquisition, fair value consideration paid, cost of investment, cost of acquisition. Let's go to punch these 2 figures. P bought the ordinary shares of S for 170,000. So as given, as taken. The value of the net assets, 185,000. Is that it? It would have been ended if the question did not have NCR. The question does have NCR. This has been the value of net assets, total net assets. But my level of investment is only 60%. See, I only acquired this company by 60%. So my share of investment is only 60%. But here we are trying to match it up with the net assets, which are the total net asset, which means a figure, 100% figure. So it will be incomparable to compare 60% of the cost of investment to that 100% worth of value of the net assets. So the need will be there to top this up with the 40% share of NCI. So I'll just have to come and top the value of my investment with the value of NCI. That is what one has to do. NCR now can then be a proportion method, can be a fair. In the first place, because they have provided to all of us with the fair value, so we can use that fair value. 105,000. That was it. Just need to top this up. That can only be the change. The NCI will bring it in. The figure is 90,000. The figure is 90,000. Okay. If I will have to redo this figure working for the goodwill by assuming the value of NCI is the proportion one, so only the one thing will change, and that thing will be this NCI. Nothing will, except NCI. Proportion of net asset method. And that's how the way the proportion is worked. 40%, the value of net asset is this, or you may take the same figure from to get that. %40 of 185,000, the figure turns out to be 74,000. Fine with this. I haven't said the values will be same. It will be different. See, only the change has brought into this figure. And only the thing that's been added into it is this, because that pro forma I have explained to you earlier on remains to be the same, except the NCI has been topped up into it. And I have told you why this has been topped up into it. Or else I have acquired 100%, this step of NCI will not come in, since my investment will then be fully 100%. So that is goodwill, step number 7 for all of you. Where are we going to present? Imagine if I was working this question where the goodwill was also a part of that question. So this will definitely come over. We know that goodwill is a non-current asset that has to fit on the top next to the investments or property, plant, and equipment. The question now we will attempt, the next one will take everything in it. Everything. Let's go to work. It will be a good question for the health of this revision. Before then we can come to focus on topic specific small questions. After that, you will not see any statement kind of a question. Rather, you will see small examples covering the specific areas like intra-group cancellation, unrealized profit on stock, fair value adjustments, mid-year acquisition. So let's just do this one last time effort of preparing a pro forma, applying all the 7 steps in one. So we had that pro forma saved with us, and I can bring that out in front. Slightly will save a bit of a time, but yeah, we will probably need to modify it according to the length of this question. We will do it. Let's come to read. So Postal acquired 65% of Steeple. Fine. 40% will be the figure of NCI on 1st of October. For on this date, the retained earnings of the Steeple were this much. We know that this balance of profit has a name to it. It's called as pre-acquisition, before acquisition. And then the two sets within which we have typical non-current assets, investments, current assets, capital, premium, retained earnings, non-current liabilities, current liabilities, and all. As well as the investment in Stifel, the parent holds a small number of shares in various other companies. And that cost them around 61,000. Interesting. Just the way we invest into subsidiary, they might have some other investments. So not necessarily whatever was invested in subsidiary will be found here, because they might have some other investments also. Like the case right now, they suggest P holds a small number of shares in various other companies. And the total of that is 61,000. So if 105,000 has been the balance of total, and they suggest in others, they have invested 61,000, then what must have been invested in subsidiary? A balancing of, what will be the balancing? 61 minus 105, 44,000. That must have been in subsidiary. So when it comes to the cancellation, we will only cancel the investment the P has made into S, not all the investments, because I did not say to remove all investments. I haven't said it, remove the investment of P in S only. Luckily, the previous question we have done, all was removed, because that question within which the P only has an investment into subsidiary. So that was the only one figure that they had invested and we had to remove. But in the question of this kind, when they suggest, okay, total is 105, 61 has been made into others, we will only come to remove that part of investment, not total investment. So variety is there so that you also cover this possibility in. And then comes, Steeple has not issued any shares since the date of action. That's fine. That's going to be the case. More commonly, the P measures the NCI by using the full method of goodwill. What is this full method of goodwill? Okay. Let me take you back to the solution of this. The two types of goodwill I have worked. So one is called as full goodwill. The second one is called as partial goodwill. This goodwill is full. And it's easy to remember, as both of those words, they start off with the alphabet F. Full goodwill, fair value of NCR. Easy to remember. And this one is called as partial goodwill. And again, easy to remember, as this word starts off with P, and proportion of net asset method also starts off with the alphabet P. So partial, proportion, same. Full, fair, same. Sometimes the question might not say to you fair method. Question might say full goodwill method. And that means fair value method they want us to apply. The goodwill has not been impaired. Fine. Market value of one Steel, and that's the reason why now they're providing to all of us with the market value of share, because they want us to apply that fair value method. Do we need to bring some alterations to the pro forma? Yes, we probably will have to. Not the first half. We'll start taking one extra thing now. And that extra thing is the goodwill, which will be a working note itself. So let's write the alphabet W next to it. Capital section, I do believe, has something extra to write. Now we will also have to come and write one more thing like share premium. The NCI definitely has to fit in. Even the liabilities will now need to be categorized into its current and non-current liabilities. Non-current and current liabilities. There you go, a little bit of modification and we are all set. This will be a working, this will be a working. Now we start off with the same way of combining assets and the liabilities in the first step peacefully, 420520. And comes 99330. It's 105,000. We also can see 10,000 next to it. So this 10,000 has been added in just the way this figure was added into. This 10,000 has been the asset of subsidiary and this needs to be combined. Don't be confused. We have to remove the investment the P has made into S. Not this amount. This is the asset of subsidiary. So this suggests S investment into somewhere. So S may have invested into shares and securities, bonds. So that will just be added. The way you have added this one into it, this will also be added into it under the banner of step 1. Then we have 78900 for current assets, 78900. And we have 261980, 26190. And the liabilities, 100,000 and 10,000 for the non-current liabilities. And comes the current liability 63800 and 23080. So assets and the liabilities have nicely been put together. Third step to write the capital and the premium of just the parent, and that is what I can spot, 80 and 120. I will just come to fix it in without any further debate, 80,000 and 120,000. The investment the parent has made into a subsidiary that needs to be removed, and we've analyzed that to be as 41,000. 41 or 44,000. 6139 plus 5, it's 44,000. You should correct me if I do some wrong figure working somewhere else. You always should take a chance to correct. Now I have corrected this amount to be as 44,000. Yeah, 44,000. So that needs to be removed. And there you go. I have removed. So the investment that the P has made into S needs to be removed. 4 of those steps, how easily on the face we have applied. Then I will go and take the help of this net asset note. On the date of acquisition and on the date of reporting, I have share capital to write. I have retained earnings to write. Do we have premium? No, subsidiary does not have any premium. So fine, the 2 of those things to write. The capital balance is 30,000. Remain to be the 30,000. Retained earnings. This has been the balance of profits when this company was acquired, 34,000, which now has gone up to 72,440. Become 64,000. 30,000 plus 72,440. This will become 102,440. The figure turns out to be 38,440. Okay with that. Now, with the help of this working note, we will be able to take one figure, this one, to share the profits to our side and to the NCS side. Remember that one figure, which is called as post-acquisition profit. I will be able to take my share, NCR will take their 60-40 ratio is. The goodwill now needs to be worked. Although it's a 7th step, so you still can work it on the way first. Starts off with cost of investment. Has to top this up with the figure of NCR. and the value of net assets. All of that knowledge, the past 1 hour or so we are into now, you have been able to regain it. Share of premium of subsidiary. Yeah, everything needs to be included. Like I said, whatever is into the column of subsidiary will have to come in, because I did not see any premium over here. And so I also have highlighted. So only the two figures could have been possibly fit in. If I have revaluation reserve, if I have retained earnings, share premium, share capital, all will come in. Whatever is on the capital side. Let's not pick and choose. This will come in, this will not come in. Anything that you see here is a capital balance, will fit in, which at the moment we do not have. But don't make a mistake of starting to put these figures into that net asset note. This net asset note is for a subsidiary. So only what being found onto this side will take care of. Okay, coming back to cost of investment. 44,000 was never given. I rather have been able to figure that out. NCI, they want me to calculate it by using the FAIR method, and we should not be forgetting the fair value method starts off with the number of shares, which right now is 30,000, as each share is of $1, so the quantity be the same, multiplied by the price of each share that they have provided, $2.2, multiplied by the percentage of NCI, which in this case is 40%. Now that's how the way the fair value method one has to apply. See, are you realizing all of that knowledge, been missing it out of your life? And how can you expect this whole thing to be kind when you do not have those basics? But generally, you might have it into your mind, but that casual way of having that knowledge not going to take you anywhere. Exactly 8 steps, how to perform, present, number of methods. Technically, you must have to be so much pro at it at this level. This is good. Once done, 6,400 will go up there. Then comes the two of those workings, which we already had worked in previous question and will be quite much of a revision. Starts off with the balance of parents' retained earnings, tops this up with the group share of subsidiaries. Then comes the figure of NCI. Okay, let's fill them off with the figure of the profits of parent, the 240,620. The group share right now is 60%, and the profit that we have worked up there is 38,440. 60% of 3,440, that's about 23064. There you go. The total is 263,684. In that systematic manner, if you, I mean, these working notes, they make the whole process a lot uniform. As you have learned once, and every time you will see me applying, I will just follow that way. This brings a consistency, uniformity. You get used to of. When you do not have the one standard pro forma of one thing, you will be confused of every time, and you will remain confused which way to go. So apply that one uniform way of getting those answers. When things will start becoming complex, trust me, these basic aspects will not go anywhere. New further steps will be added, third step will be added, fourth step will be added, fifth step will be added. But these two basic steps are not going anywhere, no matter how much complex the things later will become. This is respected. Which method of NCA they wanted me to adopt? Fair, we already had worked the fair value up there. I can literally copy and paste that amount. over here. And next to that will be the step of sharing it out of profit. NCI, share of subsidiary profits, retained earnings. NCI share is 20%, no, sorry, 40%. The profits we have is 38440. 40% of 38440. That figure is 15376. 41776. So how nicely in a systematic manner we are done with. We now can write them, those balances up there, 263684. 263684. The figure for the NCI is 41776. And let's close down all those brackets to see if we have got those answers the same as. So 78900 plus 26190, the total of 105090. It's 420520 plus 99330. It's about 519850. Here we have 105 minus 44 plus 10. It's about 71,000. So 519850 plus 71,000 plus 6,400. 6,400, is it the goodwill? Yeah, 6,400. That should be the total of 597,250. 105,090. That's the total of 702,340. We have 80,000. That's 120,000. 263,684. This will be 110,000. This will be 638,000 plus 23080. We've got the same answer second time around, but these two questions have enabled all of us to understand the overall process of how the way the things normally go up, plan pro forma, starting off with 4 basic steps on the face. And then the next 3 steps are in fact the working notes. You people have seen it, the way these working notes have been applied in that uniform way that way has been given to you. Proportion method could have been there, but actually it was a fair value method. This step of sharing the profit to my side and to NCI side has been so systematic. 40% of this figure goes to NCI, 60% of that goes to group. Profit of parent will just have to copy in it. And there you go. 7 steps. In a space of hardly 1.5 hours, you become so much knowledgeable. And you have to admit that this is the knowledge that you had been missing it out the whole of your past recent life. And roughly you probably had that in your mind, but not exactly. If someone had asked you today, you would have smoothly answered. But after this now, you will feel a bit more confident about that. I know the groundings of this topic. I know from where it starts from, the basics of it. And on the basis of that, now I can expect to advance my level because I had made sure I'm okay with. One thing that in this explanation we are left to talk about is the explanation of this thing. To conclude the goodwill, one thing is still left. So we have got one question within which I can also give you the explanation of the review of impairment. For that reason, I will have to take a help of your lecture notes, and the learning example 1.2, I will take it in front. As this question requires us to work the goodwill, not just but also after impairment. So in the first place, I will still work the goodwill and then we will review it for the purpose of impairment. So Ficken bought 100% of the equity shares at the beginning of the year for this much. So no NCI is involved. At the date of acquisition, subsidiaries share capital was this much and the retained earnings were this much. The subsidiary had got the retained profits of 200 million. The goodwill has an indefinite life, which is the case usually. Review of impairment suggested that the year-end value in use is this much and net realizable value is this. So the last paragraph of this question is all about impairment review. Let's just stick to the first one to try and work the goodwill in the first place. So it's learning example 1.2 from our lecture notes. So I will once again start off with the balance of net assets. No, we are working this question from here. So at the date of acquisition, the subsidiary share capital was $100 million. And we know that this 100 will remain to be the same 100. The retained earnings were 400. And retained profits for the year. Retained profits for the year. Can I write it this way? If you did not get it, you must have to use your accounting skills. From where the 600 has arrived from. Now the 600 is a closing balance, cumulative, that takes the opening and for the year in it both in. It's like opening T account, the opening balance of that is 400. And then the profit that they have made for this year is added up in 200 to have us what in the end, 600 the closing one. So since they have provided to all of us the profit for the year and subsidiary was acquired at the start of this very year, so this balance itself is a post acquisition profit, which I could simply fix it in outer column. And then this has been found out to be as a balancing figure. Get it? This much flexible we can be at this level, especially at this level. So now if I'm going to work the goodwill, these figures will help. Starts off with cost of investment. NCI, no, that's not there. So fair value of the net assets. This company was acquired for what price that they have paid 900. The value of the the goodwill is worth the time the company is acquired. That day standing, the value of the net assets of 500. And this figure is subject to impairment. So I will have to make a room for it. And now I can finally explain how to review it for impairment. So for impairment review, you must have to have a knowledge of it from IS 36, a standard on impairment. It suggests that impairment loss does only exist when the carrying amount of the net assets exceeds over to recoverable amount. When the carrying amount of the assets exceed over to recoverable amount, the amount by which the carrying amount exceeds over to a recoverable amount, that excess is called as impairment loss. So let's see if it is in excess or not. And then the recoverable amount of the net asset is the higher of two things. Value in use, fair value less cost to sell, which is also called as net selling price. Fair value less cost to sell, which is also called as net selling price. And these figures are given. The value in use is given as $780 million. The net selling price is given as 350. So the higher of two has to be chosen. We have carrying amount of the subsidiary. Since the review of the impairment is to be performed at the year end, so you must have to go and take the value of net assets, the one that we spotted on the date of reporting, which is 700. This has been the balance of net assets, within which I will top up this with the effect of goodwill, the one that we have just worked up there. This gives us the total of what? 1100. Which when I will go to compare it with this 780, well, the loss of impairment that I'm going to find this with as a result of it will be 780, 800, 320. But that's how the way the review of impairment one has to perform, by how far the carrying amount is in excess over to a recoverable amount that is called as the loss of impairment. In this case, it's $320. Don't forget topping the goodwill into it. This has been the balance of net assets without goodwill. And that should be topped up in it to find the value of total net asset, which is 1100. The loss of impairment that we have found now will be recorded by crediting the goodwill account and debiting it what? The retained earnings by $320 or profit and loss. That 320 when will go up there, the goodwill after impairment that they have asked, we've been able to prove it out. So we will see it also this in some later questions, but the basic of how the goodwill is reviewed for impairment by taking this question we have been able to cover. So every question brings us something that when we learn, we revise, we feel good about that. We're becoming more knowledgeable question after question. Quickly, so far, we already have been able to revise quite many things, which we were all lacking at. And after that, I also, as a student, I have a responsibility to come and revise this revision to make me benefit from, else I'm wasting time. The whole objective of doing this in the first two courses of SBR, if I'm not understanding the objective and still taking it carelessly, then it's the whole waste of a time. This is where we will take a break for 10 minutes. Upon the resumption, we will continue with this. Lots of things are coming to revise, as important as what we have done in the first half of the course. So stay tuned. Do not go anywhere else. I will see you in about 10 minutes to resume the session. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. So now we're heading towards taking these basic aspects into consolidation adjustments. Now, these consolidation adjustments are not the steps of consolidation. These are the adjustments which will make the effects on those 7 steps. Which step to effect, how to, when to, all is planned under this debate. The first one is named as intra-group balances. The second one, unrealized profit. And the last one, fair value adjustments. Under the banner of these, we will come to see the topics like those intra-group balances when those are equal, and those when those are not equal. Within that, also 2 cases to look after. A case of cash in transit, a case of goods or stock in transit. There we will come to see under 2 possible transactions to find the unrealized profit from when there has been the sale of goods and when there has been the sale of asset. So this page writes the maximum adjustments we will come across to, then how to really pass them in, how to adjust them in, which step of consolidation they have to make effect in, to add them, to subtract them. Let's get into it, starting ourselves first of all with intra-group cancellations. Now, the word intragroup means between the group members, which mean parent to subsidiary, and it can be in both directions. Well, the balances can be the balances of receivables and payables of any kind. Trade receivables, payables, interest receivable, payable, dividends receivable, payable, rentals, interest, even the loans receivables and payables. Okay. So I can give you a very simple example where there is a parent and there is a subsidiary. Okay, all set. There is a parent and there is a subsidiary, and subsidiary has made the sale of goods to S on a credit. The value of the sale is $7,000. In the financial statements of parent, subsidiary must have been a supplier, and then in the financial statements of subsidiary, parent must have been a credit customer, will result into what? Receivables from P. So the side of the parent suggests they owe this much to subsidiary, and the side of the subsidiary suggests that they owe this much from the parent. It's a mirror effect. So purchase account debit, payables credit. Purchase account debit, payables credit. Sales account credit, receivables account debit. So by the time the year will end, one of the parties suggests to pay this, the other suggests to receive this. So that is, first of all, is called as intragroup balance, as this balance that they owe to each is in between them, not to an outsider. And secondly, it's equal. So intragroup balances are required to be removed, are required to be removed from group financial statements. So when they are equal, they are easy to remove. When they are not, we will see this into my next case. Right now, they're equal. Whatever that they suggest they owe to them, they also suggest that they owe from them equal. So how will it be cancelled? While working it out onto these two brackets, remember, assets of P was added into the assets of subsidiary. So is the case with the liabilities. We simply have to come and remove 7,000 from up there and 7,000 from down here. That is how the intragroup balances are simply removed when they are equal. And when they are not, we will have one example on that to work. And that one is this. They want us to find the balance of receivables, bank, and payables consolidated. And in this regard, they have provided with the parent subsidiary receivables, cash, payable balances, so that at least we can do the basic combination task, and then we can think of adjusting intragroup balances. The following are the extracts from the statement of financial vision of painter and steamer. Included in the painter's receivable, it's 1.7 million due from S. So this is the receivables of painter. And they suggest they owe 1,700 due from S. Included in steamer's payables, 1.5 million due to P. So this has been the payable of steamer, and this suggests 1,500 due to P. And immediately now you can see that the two of those balances, although they are intra-group, but they're not equal. What went wrong? Which side has got an issue? The $200 difference that we have found, which side has got an issue? Steamer had just said check a 200,000. See, same value, $200, that difference is off. Steamer has just sent before the year end, but because of some strike, postal, industrial, or whatever the nature of the strike was, it was not received by the P until after the reporting date. Timing is only the issue, and that is a normal thing. It's a part of the system. Those checks, those are specifically are issued close to the year end. They can have a timing issue in it because of Christmas holidays, New Year holidays, bank holidays, public holidays. Because one of the party has done their part before Christmas, and the other party is still waiting for that check. And 31st of December, it's a new year. The timing is only the issue, not. Yes. Someone has written me into a chat box that the screen is not visible. From my side, it's all fine. I'm maneuvering it from one screen to another one. If it has been the same case, the others have found, can tell me, or just the one of the individual who has showed this concern in the past 5 minutes. Yeah, the others, they have given their feedback. It's fine, perfectly. So the one who has complained may have an issue at his or her own side, can go out and come back in, try to. Because what I see at my side, exactly what you see at your side. So if there has been an issue at my side, I would have fixed it by now. If there has been an issue. So since the start of the course, it has been smooth. It has even been, it is now right now also been. So you can try and exit, sign it out and try and come back in. Okay, so where was I? Yeah, steamer had just sent a check of $200. The painter has not received it. And I was discussing that normally it happens with those checks, those are issued close to the year end. One of the party has done their part of issuing and dispatching, but because of some holiday, Christmas, New Year, public, bank, the other party is still awaiting. The year has ended. So to cater this, we have to sit and see which side has an issue. We will try to adjust that issue and ultimately will cancel. So let me go and produce the solution of this question very formally in front of all of you by first of all preparing the T account respectively. The T account of so in the financial statements of parent and in the financial statements of subsidiary right now, subsidiary is a customer, credit customer. And to subsidiary, the parent is a credit supplier. And they suggest that they owe 1,700 from them. This party suggests that they owe this much. Is this the case? And we can see the two of those balances at the moment are not equal. They're really not. They are unequal. Intragroup. So what went wrong? Clearly, they suggest that they have issued a check $200 check dispatched. So they have done their part. It means before they had not even paid, they had been owing the same amount. And just because today they have paid, so payables account have been debited and bank account has been credited, which is perfectly fine. So they have done their part. They have issued the check. They have dispatched it. They're good. This side has not yet received, and their accounts, they require to be updated. So we will go to pass the double entry into the books of recipient party, which right now is parent. And the double entry will simply be the double entry of what you record when you receive a cash from credit customer. It takes on the one side, the bank account has to debit and receivables account will be credited. Bank in transit account debit, receivables account credited with 200. This way, when the 200 will go to decorate up there, over, this even will take this total down to 1500. Is it or not? This will take the total down to 1500. Bank in transit account debit, receivables credit. So when this 200 will come to credit, this will even take the balance down to the same amount that the other side originally has. And then we will be able to happily cancel it. No further talk. Yeah, to really adjust it in the way the consolidation requires it to be adjusted. So I'll have to go and do this task of combining P plus S balances. To understand, I was preparing those T account, but eventually the one has to answer it in that way. So receivables are 13,000. And I can put this into another bracket since the adjustments will come in. The balance of S is 11700. The balance of bank is 198,213. Payables are 6330. And we have this balance 10870. So the first double entry was what? Receivables account credit, bank debit. So this is a debit of bank. And this is a credit of receivables. That is the first double entry. Bank account debit, receivables account credit. In the background, you people already have seen what this double entry has achieved. Now, when we can see 15 on the both of the side, I will happily be able to cancel 1500 from up there and from down here. Good with that? That much of explanation at this level is enough. Let's not just keep on repeating the same thing again and again and again. Good. We may come across also to a situation where subsidiary has made the sale of goods to parent, suppose a credit sale worth of $10,000. The sale was made noticeably on the very last day of the year, a calendar year, a financial year. In the financial statements of parent, you can understand when they have dispatched the goods, they have recorded, must have recorded the sales. Because usually the goods are dispatched the day, delivered a day, it is recorded as sale because that day the control passes on to the buyer and the day they consider it to be the day of sale. Even if it is a credit sale and payment of that has to happen after 2 months, after 60 days, 30 days. But the day of dispatch of good is the day it is considered to be as the sale of goods. So they have recorded sales account being credited and receivables account being debited. So their accounts have started suggesting that this is the amount that they owe from them. But on the other side, the financial statements of the parent suggest nothing. Why nothing? because they haven't received the goods as of yet. So their account suggests they have never purchased any item from S. And because of that, they do not owe anything to S. This makes the two of the accounts to be unequal now, once again, because the goods are dispatched onto the very last day. And same problem of timing issue, bank holiday, New Year holidays, Christmas holidays, the goods are still on the way, stuck at customs, suppose. And the custom is not in operation because of the whole of those holidays. Stuck. It's neither on that side nor onto that side. It's on the way, in transit, or at courier company's transit. Can be any possibility, but you can understand the practicality that it happens. Here, the cash was on the way. Right now, the goods are on the way. So they have done their part. They have dispatched the goods. They have recorded the sale perfectly fine. The problem still lies onto this side, who has yet to receive the goods. So we must have to come again onto the side of the recipient party to try and adjust that. What if the goods were received by themselves? What double entry would have been recognized? Same double entry. Purchase account debit, payables account credit by the same amount. Rather, you debit the purchase account, you can debit the stock directly, since normally we do not debit the stock account with the purchase of goods. But a situation of this kind is a situation where they have, first of all, not actually received the goods. So even if I assume that they have received the goods, they would not be able to sell it the same day, consume the same day. So all of those goods will automatically become a stock. So better to debit the stock directly. So stock account debit, payables credit. With that, payables being credited, see the result we will go to achieve. See the result we will go to achieve. See the result that we are going to achieve. Now we can happy to see the same on the both the side, which eventually I will be able to cancel it. That way, that pretty much ends up the talk of this first leg of this intra-group balances. Easy explanation, but could have not just bypassed on the assumption that, I have taken about 15 minutes in total to sum up this branch of adjustment, and you now feel a little more better or confident about that you were 15-20 minutes before on this thing. Revision is pretty much required. I'm telling you, you must have to respect this. If you are now into class, spending a time designating this part of the life to take a course, then with little bit of extra efforts will be there to get the better taste of this whole thing. Means 30-40 minutes hardly it might take of your life to revise this revision the whole 6 next days. And that even you can't do. It means from the first day, you're not ready to give a little bit of time of yours to it. And then let's not just lock ourselves that we have exam in some days. Even to understand the complex aspects, and this 8 to 10 sessions we have to spend on consolidation will be good to you only when you are respecting this first 2 weeks of revision. Let's just look into that. Forget about exam days so far away from us. To learn those complex aspects and make our life easier, these 2 weeks of explanation are worth doing. Respect them as they demand. Taking gradually ourselves into unrealized profit. Okay, let's make one example to understand the whole idea of this unrealized profit thing. Can have a loss, but usually unrealized profit. We will take this first of all in respect of sale of goods. And then gradually we'll take the sale of asset afterwards. So consider this example down below where parent is making the sale of goods to S. And the value of the sale is $8,000. $8,000 has been the value of the sale, and they have recorded 25% margin on it, profit. And this shows the boundary of the group, shell, within which the two of those members, they are in it. Subsidiary has been able to pass on uh 5,000 worth of goods to a customer outside. Out of it, 5,000 been passed on. It means what must have been kept on hand? 3,000. Technically, we call it as stock. Goods remain unsold. By the time the period ends, it's called as inventory stock. So if 5,000 worth of goods been passed on to outsider, no matter for whatever the price, they might have sold 5,000 worth of goods for 10,000. We're not interested. We're interested, okay, out of 8,000, 5,000 worth of goods being transferred. What must have been kept on hand? 3,000. And that is called as stock. As far as the group perspective is concerned, we are preparing a group financial statement. We're not preparing the parent's financial statement. We need to think like a group. So as far as the group financial statement is concerned, the group realizes the profit only when, the word realizes means earns the profit only when, or to make it more, makes the profit only when, earns the profit only when the goods are sold to an outside party. Outsider. It means these worth of goods being shifted to an outsider and the group has made the profit out of it. But what stays with it? What stays with it? And they have exchanged the profit must have not been realized yet. Or you can say that must have been stuck in. This much worth of goods, they have a profit being stuck within the profit that they have exchanged in between while selling to each. And because these worth of goods are not being transferred yet to an outsider, not yet been realized. So for the reason why we always pay attention to a stock then, and we simply come to apply with the margin that is 25%, to extract the profit out of it, which is what we call it as unrealized profit, or the profit that has not yet been realized. As far as the group financial statement perspective is concerned, the group makes the profit only when the goods are being transferred to an outsider. And what proportion of the goods are still on hand within that group, the group has not made any profit out of it yet. So we have a job to always focus on to a stock and apply relative margin markup with this to get this amount. Once this figure has been worked, how to adjust, where to adjust, that's coming to your way. At least I have been able to make you understand how to find that figure. Also, this word unrealized means what? Depending it upon if the seller is parent or subsidiary is a seller, how to determine who is a seller? Right now, in this case, who is a seller? You always have to look into a principal party. Principal means the first one, main, who has done this wrong thing of exchanging the profit within the group. The P must have not sold the goods to S by recording a profit in between, but the P has done this. P has started this whole wrong thing in it. Main seller, first seller, principal seller, whatever you wish to call. So in my given case, P is a seller, right? That's how one has to determine who is a seller. So if P is a seller, what journal will it be there to account for? And when subsidiary is a seller, what will it be? There's going to be a slight difference, and you'll be able to nicely contrast because I will go to write it both at the same space of the page. Nicely contrastable it would be later on. See, problem lies in a stock. It means stock will be the first thing to take an adjustment. The amount of stock, whatever you have, has been inflated because this includes the profit that they have exchanged in between. So this figure of 3,000 has a profit in it, which should have not been. So to bring the stock down, I definitely have to have an accounting sense with me. Stock has to credit. Is it? So you cannot cram these double entries. You should be having the sense of that with you, and then can construct it live the way I'm explaining to you that why to credit the stock. You need to have this whole logical sense in your mind that why to credit the stock, because the stock is inflated as a result of profit being embedded within, included within. So to bring the stock down needs to credit because it's an asset balance. What do I have to debit? The profit has been exchanged, which should have not been. So with that exchange of profit, the profit has been recognized. So profit has been recognized means the profit has been overstated. And to restate the profit, I must have to bring the profit down. And to bring the profit down, one has to debit definitely the retained earnings. Respective retained earnings, one has to credit. If P is a seller, the retained earnings of the P. If subsidiary is a seller, then of subsidiary. So that should be the double entry. Objective is to eliminate the profit, remove the profit, reverse the profit, cancel the profit, not to record the profit. So to cancel it, definitely the reserves will have to take the debit effect of this, and the stock has to credit also to take the profit out of stock. After this, even you may not get the better picture of where these amounts will go to hit in those 7 steps. That I also can explain. So if P is a seller, very next to, I also can demonstrate the exact placement of this debiting. Okay, let's divide this whole page in 2 halves so that we can not be confused about. Remember this working note group retained earnings for about 2 or 3 times today. We have prepared this in our questions. It starts off by taking the balance of parents profit, and then we top this up with the group share of subsidiaries retained earnings. Is it like this? I was supposed to write that in red color. Never mind. Anything is possible when you're a digital platform. This is going to be the placement of this unrealized profit. Check this. And why not? Think of it why. Because I'm supposed to debit the profits of parent. So these are the profits of parent first of all. And then my objective is not to record the profit. My objective is to remove the profit. So that's the removal of profit out of it. Connect it. Don't just cram it. If you will cram it, again, the next moment you will forget it about. Debiting the reserve means deducting it. And the objective of the topic already been clarified. That objective is to cancel it, remove it, eliminate it. So you can't be eliminating it by adding it once again, rather deducting it. And these are the reserves I am supposed to debit. So very next to that, I am being able to debit. This will only become easier for you when you will start learning it, remembering it this way. Okay. Now, by the way, you can change the sequence. You may not need to write the URP very next to it. You even can drag this amount, this place. Point is that this working note will have this effect coming in. May not very next to this figure, could take this 3rd spot. but has to come in. Okay. Now, when subsidiary is a seller, where this debiting the reserves of the subsidiary will have to go in. So that will go into the net asset note. And we know that about 3 times today, since the start of the course, we have maintained this note of net asset. It takes the first column of acquisition, second column of reporting date. On the left-hand side, we have share capital balance, then we have retained earnings. Usually these components are there. There we come to fix the figures. Aren't we familiar to this? Yes, we are. Now, because we have to remove the unrealized profit from the subsidiaries profit. So this net asset note is for subsidiary. These retained earnings are for subsidiary. So very next to that, I will come to write this unrealized profit. And we'll go to record. Now, which column should I be taking? There are some etiquettes. You can't just be casual about throwing the amount anywhere. The column of acquisition cannot take this because, again, common sense. You're not standing it onto a date of acquisition, purchasing and selling. It's happening after acquisition. So this column should not be taking a figure. This definitely will. And when it will be a deduction, because main aim is to eliminate. So you can't be adding it has to be deducted. That is a placement. So after even you're done with figure, you're not done yet if you do not know where this figure will have to be exactly placed. See that when you decorate, you put a lot of shells, and then on the shelves, you put a lot of decoration pieces. So if there are 3 or 4 shells where you have to put lots of decoration pieces, so if you do not know or you do not have any plan, you will not be able to put the right decoration piece onto the relevant shelf. It's like that. You've got this figure done. Now, where exactly this figure has to be placed, positioned, that concludes the explanation of this. Well, double entry has to be kept in mind. This will give you the marks. Take that working note out and fix that adjustment into it. And the positive sign, negative sign to deduct it, to add that also. This double entry is your old brain work. It's happening in your mind. Okay, what to debit, what to credit. That's none of the thing that you have to really write it. Double entry is all for your thought process. Okay, this to debit, this to credit. So, okay, fine. This will give you the marks. The pro forma of consolidation has to be effected, and that you should know ultimately in the end, this is the working note. This is the place this figure will hit in. Example by example, moving forward, and you're realizing it that this is that knowledge that probably I have been taking it too casually in my life. Everything that's being explained to me in the past 2.5 hours or so is a very useful knowledge. It's knowledge that I've been missing it out from all of my life, the past 1 year, probably 1.5 years. So first thing first, you should know how to calculate. Second, construct the double entry at the back of your mind, this to debit, this to credit. Don't try to cram it. Talk to yourself, okay, why am I supposed to credit the stock? What's the whole logic behind crediting the stock? What's the point of debiting the reserves? Okay, once this logic is clarified, and then exactly know, okay, which note am I supposed to fit that 750 into it? If P is a seller, if subsidiary is a seller, and such a nice way, these whiteboard explanations, I'm making it for you in my handwriting, and you will get the copy of that into your hands later on, exactly what you're watching it onto a screen. On this, we have got, I guess, one question to work. Let's do it before we move a little further after. Calculate the unrealized profit. Oh, by the way, I was forgetting one thing. I am still forgetting one thing. We haven't discussed to credit the stock where. Now, we have talked about debiting the reserves. But where the credit of the stock will go in, I guess it's too easy. regardless of the fact that who has been a seller, crediting the stock will take a same treatment. And that treatment will be to this. If P plus S minus the unrealized profit. Just the way intra-group cancellations you people have performed from the figures of receivables, banks, and payables, same way stock will be one of the component where you will just come to subtract the URP from this way. Regardless of the fact who has been the seller, that treatment will be the same. Why? Because we have the stock of parent over here, we have the stock of subsidiary over here. So you just have to deduct the URP. It will be deducted from the stock of parent either or from subsidiary stock balance. Debiting the reserve was something that one has to be knowing about, because the treatment of that is different for both, not the same. Have I been able to make myself convinced to all of you? So we can take this question, which just requires us to work the sale of goods and the unrealized profit out of it. This question is focusing on computation. During the year SAM, which is an 80% subsidiary of the PAM for a 1.8 million, adding the markup of 20%, goods with the transfer price of 450 was still included in the PAM's inventory. We have provided to all of us with pricing, markup, and then the portion of the goods, those are still on hand. Which question is that? Let's number it. Sixth number. So P has been the one selling the goods to S 1.8 million. There has been a markup of 20%. Yeah. And then they suggest what proportion of the goods are on hand. 450. We're not interested what's been passed on. We are interested only what's been kept on hand. This is 450. And we will use this 450. The next problem is that, okay, if the markup is available and you do not have a cost, because markup is on cost, margin is on sales. So the only last worry is that the 450 that they provided to all of us is the sale value of the goods, the cost price of goods. This suggests clearly that this is the transfer price, which is a fair value at which the goods are transferred. So which means the sale value. The price at which the goods are transferred is the fair value, equals to the sale value. Concluded, this 450 is the sale value of the goods, and the markup cannot just be applied. And we have the way to transform the markup into margin this way. Markup divided by 100 plus markup, you know that way, should give us the figure of 75. That's it. This time they do not want us to pass an adjustment. They just wanted us to calculate. And even if they had wanted us to pass an adjustment, we know how to pass it. What to debit, what to credit, exactly which working note has to take the effect in. We have that explanation with us, not let me keep on repeating it again and again. But that's the first part of it. Let's get ourselves into a second one. In the post-action period, P sold goods to S, its subsidiary, at a price of 6 million. Okay, so once again, P is the one selling of goods to S at a price of 6 million. Fine. Next to it, these goods had cost play 4 million. Half of these goods were still on hand at the year end. 50% of the goods are still on hand. And this question is a different one because they have not provided to all of us with the markup margin. They rather have provided with the sale value, with the cost price, so that we can work the profit. And then we can just take a proportion of that profit, half of that, 2/3 of it, 1/3 of it. So that is costing them around 4,000. So if I have to calculate the profit overall, should be 6,000 minus 4,000, is it? Well, this is the profit that the P has made out of this transaction. And then they say that the 50% of the profit is not realized. The other is because 50% of the goods are on hand The other 50 are not. So I will go and take this and will pass the adjustment with that. 2 by third of the profit, 1 by third of the profit. They could have said anything. So this can be another way of finding that answer. Not necessarily always the margin markup will be used. Fine. So we are also done with this leg and can also take the next. Yeah. See, all of those ticks suggest we have covered this, and this, and we are left to cover this one, upon which might the course of today will end. So let's take ourselves into the sale of asset, which will be a continuation of the same adjustment we are into right now. But in fact, the sale of goods, we are going to have now the sale of assets. And for this, we have that question to work. That question is numbered 7. Let's read it. The P has bought an asset for 100,000 on 1st of January 2005. Depreciates the asset over the life of 10 years on a straight line basis. On 1st of Jan 7, P sells the asset to S for 98,000. So that should be the balance of proceeds. The life is given, the date of sale is given, and they have started depreciating it over the remaining life of 8 years. So we will have to investigate how come 8 years because of this. Purchase day 2005, disposal day is 7. So 2 years have been expired. So the remaining life has to be definitely 8 after 10. After 2 years of expired life, minus 10 equals to 8. Even if that 8 thing was not mentioned, we would have figured that out. Basics of accounting, these are. So first thing first, let's draw a picture to understand who has been the seller, who has been the buyer, the whole of that stuff. P looks to me still is a seller. An asset has been sold by a parent to subsidiary on 1st of Jan 2007. Then the proceeds are also given. $98,000. Apart from that, now they're telling that, okay, the asset was purchased in the past for this much. And back in 2005, it was acquired. And the life that they have told us about is 10 years. So I guess I have copied almost or everything on the paper itself. 98,000, the proceeds, the life, the date of purchase, the cost. No need to look back. Now all of the stuff is there up. So first thing first, I must have to calculate the gain, maybe a loss that they have shared in between, which is an everyday sort of task. So I will have to stand on to the day of disposal, which is 1st of Jan 2005, and try and find the assets carrying amount, which is going to be worked this way, divided by a life multiplied by 2 years. Finding the carrying amount of the asset is not a consolidation thing. It's something that we are good always at, no matter what stage we are at. Finding the assets book value, carrying amount, net book value, using the straight line method of depreciation. As long as we are taking a good care of the facts, the 2 years have expired from 2005 to 2007. While the proceeds on the disposal, standing it onto that, they had been like 98,000. So as a result of it, they have been able to make a gain on disposal of 18,000 out of it, which should have not been the case. and the whole of that talk will come back to Arve, who had been a seller. So I should debit the reserves of that party and credit. This time I should have to credit the inventory. No, rather I will replace it with the asset. It may have been a plant or building or whatever the asset was. That will rather be credited. So the double entry will remain to be the same as above, except I will replace the stock with the respective asset account. Nothing, I guess, to be explained more and more, because we are under the banner of the same topic, where the aim was that they should have not exchanged the profit. And if they did, we have a job to do, and that job is to eliminate that profit, cancel that profit, reverse that profit, remove that profit. So the removal of that has to be achieved in the same way of debiting the reserves account, crediting the asset account. But yes, it will create one more issue. Means in two steps, this will be adjusted. The first is to eliminate this unrealized profit that they have made. And second thing is to adjust the depreciation which the other party has started recording. Analyze that situation. For S, it must have been a cost of buying an asset, since S has paid 98,000 to acquire it. So it must have been a cost to them. And as far as the subsidiaries perspective is concerned, if the cost of buying an asset to them is 98,000, will turn out to be a depreciable amount, because normally whatever the price at which an asset was acquired at turns out to be a depreciable amount to start depreciating based on to it. So they have used this 98,000 for the purpose of depreciation. The remaining life was 8 years, which concludes the figure of the depreciation that they have ended up recording is 12250. Now, this is the chart that they've been able to make. 12250, the figure of the depreciation they have ended up recording, and which is good as far as the individual financial statements are concerned. It's good, but not good as far as the group financial statement is concerned. And we're preparing the group financial statement right now. Just 1 minute. So we are preparing a group financial statement right now. See, if I'm preparing an individual financial statement, it would have been fine. Because as far as the individual financial statements are concerned, that they have acquired an asset for 98,000, and to them it must have been a cost of buying an asset, which turns out to be a depreciable amount for the purpose of depreciation, perfectly fine. But as far as the group financial statements are concerned, in the very first step, I have been able to eliminate the profit that was once being exchanged. With that elimination of the profit, this takes the value of the asset back to 80,000. Check this out. While the profit was eliminated, debiting the retained earnings of the parent by 18,000 and crediting it what? Asset account. So when the asset account is credited, this takes the value of the asset back to 80,000 for the consolidation purpose. See, asset account is credited, which means the value at which an asset was sold now will be dropped by 18,000. So the value of the asset now being back to 80,000. And this should have been the amount to use to calculate the depreciation. Since the profit in the first step has been eliminated, the asset value has now been restated back to its original value, which is 80,000. That would have been the amount on which the depreciation should have been worked. This is actual. This is should have been. So as a result of that, by how far they have started recording it, extra depreciation recognized, extra. Which now will require to have reversal. This much has been recognized extra, will not need to be reversed, and to make the reversal of the depreciation, will credit the profit account, debit the asset, because we are reversing a depreciation, not recording. So one way of getting this answer is this way of comparing what should have been. And the second way of getting that answer done is what? See the difference of two of those amounts, which in fact is the difference of gain. That is creating the whole issue. So pick that and divide this by the life, you will be able to get this answer directly this way. Because this 18,000 is creating the whole issue. That exactly has been the difference of 80,000 and 98. So pick that difference equals to gain and divide this by a life to get this answer this way. But you could have not been understood it if I had done that only for you. This is the proper way of understanding what actually has been charged as a result of profit being exchanged, what should have been charged if the profit has not been exchanged. So this has been the amount. As a result of that, they have been recording excessively, which one has to make a reversal of that. Could have been found by simply taking a gain divided by a life 2250. So unrealized profit on the sale of asset has also been finished. In the first step, you have to make sure that you work the gain or maybe a loss the way that you do in normal life. No consolidation thing in it, working the gain loss onto a disposal. And then in the second step, start thinking over to what is the value at which an asset was acquired, must have been the depreciable amount to them to depreciate actually. But what if the loss or the gain had not been exchanged? What should have been the charge then? And then compare the two of those figures up to find it out if they have excessively charged, if they have less charged. In the case of loss being exchanged, it will be the case of less recognized. It will be the opposite of that. Everything will be opposite when the loss in case had been exchanged. Because in the case of the loss, the value of an asset will rather understate. With the recording of the gain, the value was inflated. With the recording of the loss, the value will rather deflate. And they would have used that deflated value to calculate the charge on that. And the depreciation had actually been charged less than, which when should have been charged, should have been more. So in that case, the answer then we will get will be the answer of less depreciation recognized. And rather we will come to top this up with further depreciation. Okay, this pretty much ends up the second leg of this consolidation adjustment by all of its aspects. You see, although I'm revising these things, but I'm covering it up, everything, not just leaving a thing or two in it, just because you'll be able to see it at your side. And after that, you still do not tomorrow, when we meet up for any session, not literally I've used tomorrow. Tomorrow means in future. If we meet up for any session, these things come to our way and you're still having a question mark at your side, what's happening, then, I mean, see at your side, whatever the benefit that you can get out of that because of this whole revision thing that's going on in so extensive manner. Next up is fair value adjustments, impairment of goodwill. We already have seen this impairment thing before in one question. This question will come to revise. The new thing in this question is fair value adjustment. This question will start, we will not be able to finish. So what we can do, we can try to fix in a little explanation on the way just to complete the course. And that discussion is in regards to mid-year acquisition. This question requires us to calculate the goodwill and group retained earnings. We will do this FEA thing the next time the course will start. But this we can fix it in next 5 to 7 minutes of explanation. Mid-year acquisition. Now, what is it? Mid-year acquisition, as the name suggests, mid-year. What does that mean, mid-year? And what will this have an effect onto our consolidation? Mid-year means during the year at any time. Pisto acquired 100% of SLAW on this date. The net assets of two companies at December 8. See, December 8 is the year end, and they're acquiring that company on a date that does not seem to be the start of this year. That is called as mid-year acquisition. And this needs to be checked by ourselves. No one will come and tell us except ourselves. We will have to keep on concentrating it on the date of acquisition and the reporting date. In the first thing in the question, we should have to do this, because this mid-year acquisition in the questions are hidden like this. Have to find it out by ourselves this way. Retained earnings are provided, share capital is provided, then they're providing to all of us with some other information. Retained earnings to start the year with was this. They want us to calculate the two of those workings. We're pretty much aware of it, goodwill and retained earnings. Main issue is to deal with that mid-year acquisition. So for that reason, if I'm working this question number 9, I will do a bit of an analysis. The year ends on 31st of December 8, which definitely takes a start on Jan 8. The acquisition date is 31st of October 2008, which definitely falls during the year. So by the definition, this is called as mid-year, as the company has been acquired during the year. Now we can do an analysis of, okay, how many months we have it before and after. So 10 before, 2 after, post-acquisition. What will be the effect of that on our consolidation? Definitely, it will affect the profit calculation, since our aim is to take the profits that the subsidiary has made after we become an owner, and we become an owner during the year. So we will not be able to touch the profits of first 10 months. Only the last 2 profits are for us, because these are the 2 months of profits we have had started having a control over to, not this. So some months calculation will be included. The rest will remain the same. I still will have to combine assets, the liabilities, step third, for everything will remain to be the same, except when it comes to the computation of the profit, we will be able to take only the last 2 months of profit to take our share from, and NCA then will take there. And how will this be achieved? See, the profit when the year starts, it was about 175,000. And by the time the year ends, reporting date becomes 193,000. This will enable us to find the balance of profit for the year. So what is the profit that this year has made out of it? 175 to 193, that's going to be 115 and 3, 18,000. Now this is the profit that this year has made up. And I simply can prorate it by working the profit for the last 2 months by this way. It needs to evenly accrue unless until they state it somewhere. Otherwise, it will be accrued evenly. So that's gonna be 3,000. So we are not least bothered to even work the profit of first 10 months. We just need to work those profit within which we have had a control over to, and these are the profits of the last 2 months. Based on to which, if I go to prepare a working note of net assets, I will be able to prepare share capital, retained earnings. So capital balance is given as 20,000, which we know that is not going to change. The profits at the reporting date are 193,000. This is the profit that we have made in the last 2 months. This then will turn out to be a balancing one. See how have I got this balance done? If I know the profit of the post-action period, and if I have been provided with the profit of reporting day standing, this could have been found out to be as a balancing one. Once this working note is completed, the life of ours will become easy to work anything based on to that. For example, they want us to calculate the goodwill. So goodwill will have no effect of cost of the mid-year acquisition. Same steps will be applied. I told you the effect of this mid-year acquisition will be on the computation of profit. That is it. The investment into the company was 300,000. Well, the value of the net assets acquired are 210,000. That we have taken it from here. You see, if you do not work this amount right, this will never be right. This will never be right. So everything depends on what you have done previously. You have worked this amount, but so important to work because this amount has made you to get this one first. And then this one, which we later on are using it for the purpose of computing the goodwill. But it's you're not watching me prorating the goodwill to 2 months or something like that. It's still going it the same way as like a normal question. Prorating will have an effect onto the profits working. It will still have to start off by writing the balance of parents' profit, which in this case is 460,000. And I will be able to top this up with the group share of subsidiaries retained earnings. And that we do not have to rework because we know that figure is 3,000 from the computation up there. Okay with that? So this is that thing that I could have fixed it in to finish the course of today, except that fair value adjustment thing was not worked. It can take some time. And then we will be on to a statement of profit and loss. I hope the next time when we will meet up, we even will be able to start with the complex aspect in the later part of the course. Or if not, at least whatever this basic revision phase we have planned will be finished the next week. What we have done today, tons of the knowledge that I have shared, you should have to thank me, not by the way of saying thanks, by the way of revising it. To realize the importance of that is a thanks to me. You respect this revision phase is a way of saying thanks to me. If I had not done that for you, you would have maybe not in the better position to even start off the complex aspects of consolidation. You will realize it the moment I will start off the complex aspect. You will then realize it 2 weeks after the importance of all of that. Because there you get to really see how much of that basic stuff is connected to those complex aspects that without having that basic stuff and groundings and foundations, no way that you have a chance of advancing yourself. So all of the stuff being done, 6 days you have, the whole weekend, today and tomorrow, 5 days even after. Before you come on to the next Saturday course, please come up with the revision of what I have revised so that by the time you will meet me the next week, we easily can connect and progress further. That is it for the course of today. Have a good weekend. I will see you the next Saturday to continue. Thank you very much.